once again, everybody. As you know, my name is Lori Page, and I lead the advisory team here at Sound Wealth Management. Few words can dampen the cheer and optimism of a new year quite like taxes. Let's face it, the time for holidays, time off, and family should be a time of celebration, not a burden. But if you approach taxes with an eye towards reducing your liability for next year, the concept becomes a little easier to tolerate. And indeed, there are numerous tax saving strategies that you can implement that could potentially reduce your tax obligation. So let's take a look at a couple of the common strategies. First, turn your losses into gains. If you anticipate that your investments will yield short or long-term capital gains, you can offset these with realized capital losses, according to the IRS. For assets you hold less than a year, these short-term gains are taxed at ordinary rates from 10% to 37%, which you can offset with short-term losses. Similarly, for assets that you hold longer than a year, long-term gains, the gains are taxed at a top rate of only 20%, which you can reduce by long-term capital losses. If your losses exceed your gains, you can deduct up to $3,000 in capital losses against your ordinary income on that year's returns, while carrying forward unused losses, if any, to future years. Accordingly, you might consider avoiding short-term capital gains, since these are taxed at higher rates. If you're anticipating a short-term gain, either offset them with short-term losses, or else consider holding on to the asset for at least a year when they become long-term assets. Next, avoid the net investment income tax. The IRS assesses a 3.8% tax on unearned income for high-income taxpayers, which applies to single taxpayers with a modified adjusted gross income of $200,000 or more, and for those who are married and filing jointly with a modified adjusted gross income of $250,000 or more. This increases the top rate on most long-term capital gains to 23.8%, which applies to interest, dividends, royalties, and rents, among other items collectively called net investment income. Assets that do not fall under the net investment income classification and thereby avoid the 3.8% additional asset tax distributions from IRAs or qualified retirement plans, annuity payouts, and income from tax-exempt municipal bonds. Consider these distributions to avoid additional tax liability. Looking forward, as tax laws change frequently, be sure to consult a tax or financial professional to assess ways that you can manage your tax burden. If you need help with your tax strategy, be sure to call the professionals here at Sound Wealth Management from most states across the U.S., where Sound Wealth Management is more than just our name. Have a great day, everyone.